What's going on, guys? Welcome back to another video. We just came off a wild week in the markets last week. We have a crazy week in the markets coming up this week, and it is probably the most important week for the market for the next couple of quarters here. We are about to get the interest rate decision on Wednesday from the Federal Reserve. We are going to be getting an interest rate cut, but there is a lot of debate over what that interest rate cut is actually going to be. Is it going to be 25 basis points? Is it going to be the prevailing expectation right now for 50? Or is it going to be 75, which some of the governmental leaders that we have right now are actually begging for, as we will take a look at in an open letter to the Federal Reserve. So we have a lot to talk about in this one, guys, and most importantly, we are going to be drawing some comparisons between what we're seeing right now in the most similar situation in terms of where we are in the rate hike cycle and the cutting cycle that we have seen in the past, also as to where the market is when we started lowering rates. Now, before we get into all of that too, I want to give a special shout out to one of the Discord members, Jay. I'm going to throw the screenshot of the trade up over here. Over 6,000% on the Oracle post-earnings trade that I called out in the pre-market plan that all of you guys get every single day in the community. Now, again, you guys get all access to all the educational courses, all the pre-market plans, all of the watch lists of stocks, forex, and cryptos about to explode before they do. We have some other epic trades going on right now. The AT&T is doing very well. The Visa's doing very well. We had an epic week last week. It's looking like it's going to be an epic week this week. And I'll also show you guys some of the day trades from today as well. This one was a fun one. You can't really see it here, but I took a little scalp here down to this area, which was very fun. But this one, recorded this trade. Nice little move off the bottom here out of these zones that I give you guys every single day. So if you guys are interested in that, taking your trading to the next level in overall financial education with the macro research reports that I give you guys too, make sure you guys check out that link down below. Everybody gets 2 weeks free. So let's get into it. The first thing that I want to take a look at here with you guys is this open letter. So to the Honorable Jerome Powell, we write to you today to urge the Federal Reserve, the Fed, to cut the federal funds rate currently at a 2-decade high of 5.3%. by 75 basis points at the Federal Open Market Committee meeting on September 17th and 18th of 2024. Given the Fed's confidence in inflation moving towards its target of 2% and data indicating slower job growth, now is the time to swiftly move forward with rate cuts. Now, that last part is correct. Now is the time that we should start to see rate cuts. But the problem is that not only just the people in the government don't have really any idea what this would actually do to the market here, a 75 basis point rate cut. I think a lot of people are misunderstanding the current landscape of where we are in the market here and how a 75 basis point rate cut would be catastrophic for the market. Because most people really started their kind of journey in the market here looking at trading, investing back in 2020, and rates were really low. People like to associate rate cuts and really low rates with the market screaming to the upside. And in this case right here, it doesn't necessarily look like that is going to be the case for a variety of reasons. The next thing that I want to take a look at here with you guys is the most similar period that we have seen historically to what we're seeing right now, and on it, sadly, it is 2007, 2008. We went on a pretty aggressive rate hiking spree from 2004 all the way up to 2006 here. We held rates at those levels here, right around, you guessed it, 5.25%, and then they started cutting rates in September of 2007. Okay. Now you might be thinking to yourself, well, hold on, STV. Where we were in the market at that time with the macroeconomic effects on what was happening are pretty different to what we're seeing right now. And I would actually say they're not a whole lot different. We see home prices at elevated levels there. We see unemployment moving to the upside. Now, the inflation element of this obviously is different. And then we obviously saw the over-leveraging of the credit default swaps and all of the other elements of what happened with the housing market back in 2007, 2008. But there is another situation looming right now that could be equally as bad. Now, I don't want everybody to watch this video here and say, oh, he's being incredibly bearish. He thinks the market's going to collapse. what I need everybody to realize is that we cannot operate in the market thinking like everybody else and, oh, rate cuts are incredibly bullish and we're just going to rip to all-time highs and never come back to the downside. We have to understand the true risks in the market, because if the dominoes start to fall, we need to be able to protect ourselves from any of these potentially aggressive moves that will happen. So let's look at the chart here. September of 2007, where were we? We were, one, very close to all-time highs, which right now we're about 1.56% away from all-time highs in the market after we saw that initial rate cut, followed by some more. We ran to all-time highs here, busted through, and then for the next 2 years basically fell 56% in the market. Not good. Not necessarily what we want to see out of the market, ladies and gentlemen. Nobody wants to see that. But let's start to think about the actual situation here, and why, and kind of the way I'm viewing this. So the most important thing right now is currencies. Not a lot of people are talking about this, and it's really, 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 really critically important. So we've talked about this a couple of times in the past, but what tends to happen to a nation's domestic currency when their central bank cuts rates? Well, their currency is going to typically devalue. The reason for that is that as all of the rates in that market start to come down, lending rates, mortgages, car loans, treasury bond rates or yields start to move down, well, there's going to be less of a demand from foreign investors to actually come in and purchase those types of securities. So there's less demand for dollars. It doesn't necessarily mean, unless we see the unwind of the carry trade, that there's going to be more of a supply of dollars on the market, but that is typically what happens. And when you look at the dollar right now and where it is, we're in a very interesting spot. If we start to see the dollar push lower from here and break this pretty strong level of support that we are currently sitting at, well, we could easily see it move down sub 100, and that could be the spark for USD JPY to continue lower. And again, this is the initial spot that we were worried about with USD JPY here. This is really the big area that if we push down lower, sub 140, we could have some pretty significant issues for the broad market here. Now, what happens in that scenario? Well, these foreign investors, if they get margin called, or even if they're domestic hedge funds that are taking out loans of yen, converting it into dollars at super low rates, and then buying U.S. securities and U.S. bonds, well, if they get margin called, obviously they're going to have to sell those assets and repatriate those funds back to Japan in order to basically make it good on these loans that they have from these financial institutions. So it basically ends up in another cascade of selling, very similar to what we saw during that first initial round of unwinding of the carry trade in July going into August. Now, the aggression and speed of these rate cuts is incredibly important. Again, if we get that 75 basis point cut, that's going to significantly devalue the dollar. We're going to see the yen strengthen against it, and we could see USD JPY aggressively move to the downside, causing that repatriation. 25 basis points and moving a little bit slower with a little bit more caution, I would say that that is going to be a really, really good thing for the market. Now, what are we looking at in terms of what the market's expectations are going into Wednesday? Well, there's currently a 63% probability that we are going to be getting this 50 basis point rate cut, as you guys can see right here, and a 37% probability that we're going to get a 25 basis point cut. Now, 25 or 50 at this first meeting really isn't that big of a deal. It's not a crazy difference here. I think the Fed should start with 25 and then see how the data ends up coming out in the time period from September going into November there. But again, there is no October meeting, so they could go ahead and do a 50 basis point cut to kind of take care of September and October. But what we really need to focus in on is what's going to happen with these expectations going into the end of the year, which right now we're still pricing in about 125 basis points of easing from the Fed, which is a lot. And again, if you start to see these expectations moving back in the other direction, if unemployment starts to drop, growth starts to head to the upside, and inflation really doesn't start continues on its downward trend right now, then these expectations would most likely move back up to 420, or basically that 100 to 75 basis point area right there for those expectations. And we would also expect to see the overall bond market have an increase in their yields as they don't necessarily have to have all of those positions already locked in. And I want to talk briefly about the bond market right now with you guys, because I know a lot of people are talking about TLT right now and how this thing could be just an absolute monster moving to the upside. I know. The weekly chart looks really good. To me, this trade seems a little bit obvious right now. If we end up getting a weekly close, again, above that 101 level there, that we've been really fighting over these past couple of days, I might be interested in taking a small position on this. I probably will hedge it with something like TBT or in the futures market with ZB. So just taking a look here again at yields, US 10-year. Where are we? Well, we're at a pretty dangerous spot here as well. Yields could continue down to these levels, and obviously that would be bullish for TLT. To me, though, I think they've priced in a little bit too much easing into the bond market and a lot of the other probability metrics that we look at in order to determine what the overall prevailing market expectation is for these cuts. And again, data is going to be incredibly important after this first round of rate cuts on Wednesday. So, to kind of wrap this all up for everybody, is it possible that over the next, let's say, year or so, we get a pretty significant downturn in the market? Yes, but only if the Fed makes a giant policy mistake, cuts too aggressively, the dollar starts to devalue, and USD JPY starts to move to the downside, and we see the further unwind of the carry trade. That is the risk of the market right now. And again, like I said before in this video, this video isn't to come out and say, oh my God, the market's going to collapse. It's to make sure that everybody understands what the true actual risk is out in the market at this current time, because there is always a risk of something happening. And as market participants, we have to be aware of that, because if those dominoes start to fall, we are going to be prepared for that and able to protect ourselves from any significant market downturn. So team, it's going to be a really wild week. For those of you guys in the Discord, I will see you guys on the private live stream tomorrow morning. For those of you guys that are about to hop in, welcome. You are making the right step in your trading journey, financial literacy journey. Again, everybody gets 2 weeks free, linked down below. But that is going to wrap it up for this one, everybody. I'll see you in the next one. Peace.